So you made a comment also in kind of recession framework, but not, and stagflation more to the point, I think. Oil market rapidly transitioning to being concerned about global growth momentum deteriorating. The issue for markets is that the labor market remains too firm and wages too strong, such that core services inflation stays too high for too long, preventing the Fed from reacting to any growth deceleration. The Fed will be late to ease policy, and impact of eventual rate cuts will take longer to actually improve conditions. Stagflation environments are real tough for risk assets. That was what you wrote for clients. What was the time frame of that? When does that kind of start to become more of a headwind for equities?
Yeah, look, I think anyone would be surprised, given the geopolitical concerns, how weak oil has been over the course of the last 2 to 3 weeks. And so, because we know that supply growth being restricted by OPEC plus, Saudi and Russia have continued to take barrels off the market. So, as there's rising geopolitical tension, the potential for the Middle East strife to move further, get more aggressive, you would have thought that the oil market would get even tighter. And so the fact that the oil market has rejected that premise suggests, I think, that folks are more concerned about demand for oil than they had been previously. And while I don't think that demand concern is necessarily coming out of the U.S., because we've largely seen, a still firm demand environment here, the data out of Europe and out of Asia, particularly China, has been such, I think, that demand concerns are becoming more top of mind. Mm-hmm. And so there was a bit of demand concerns are out there. Oil is selling off, which is leading to bonds rally on kind of growing recessionary fears, which for some reason, right, was leading to equities up, because equities were basically going to be benefiting, I guess, from this multiple expansion that comes from the lower interest rate environment. But that's a fleeting exercise. If we are, in fact, going into recession, which I suspect we are going to be going into one, as I mentioned, in the US at some point next year, but globally, we're going to be seeing that sooner. You don't want to buy equities that are going to be facing deteriorating earnings outlooks. And so, again, I think it's about this kind of very bifurcated equity market that we have, at least in the US, where you have, Mag 7 plus Lilly, right? So that's the new Mag 8. So I guess that's the Mag 8. You have 8, 15, whatever the number is, very good stocks that are cash rich, that are benefiting from a higher interest rate environment, that still have secular growth momentum to it. And then you have the other 485 stocks or so that are having a much harder go at it. And the areas that are going to suffer from growing recessionary momentum globally are things like banks, small caps, some cyclicals, industrials, and the like. So I think that's the reality that we're in. So that comment was kind of geared towards, underweights in Europe and in small caps and in banks. And this idea that, well, the Fed's going to react to it, so you don't have to fear it. I think that's the misplaced part, because I don't think the Fed is going to react aggressively to a growth slowdown. And the Fed is certainly not going to react at this point to an earnings growth momentum slowdown, if that earnings growth momentum slowdown is being driven by higher wages, right? I mean, because that's the inflation part of it. So that's where now if and when it's going to affect Apple and NVIDIA and Microsoft. Truthfully, I don't, to be honest, I'm having a tough time finding, a real structural underperformance case for the Mag 7, names. And part of that, I think, is they've continued to be increasingly seen as a safe asset, right? And I think they're even becoming safe in comparison to U.S. Treasuries, right? I mean, not T-bills, but do you want to own a 30-year bond on the U.S. government, or do you want to own a 30-year bond on Apple, or do you want to own Apple equity or Microsoft? I think there's an argument to be made for some of these corporates over sovereigns. And I think there is an element of people who are saying, I'd rather be involved in some of these stocks that have pricing power, that have cost control, that can grow free cash flow, particularly if I compare that to a U.S. government, which has no pricing power, has no cost control, and can only print more money to, to pay its bills. So that's the dynamic we're seeing. And we're seeing, Qs versus IWMs making new highs every day, right? Qs versus SPYs or Qs versus any other sector are making new highs regularly. And I think the market is seeing that. It's accelerating that trend. Corporate buybacks are favorable, right? All those companies basically buy back stock. Many other companies don't. So from a passive perspective, there's momentum there. So I don't think it makes too much sense to try to, use those as the vehicles to be short when you could be short, some of these other areas in the market.
All right. So what I'm showing right now, and most have probably already picked up on this. In fact, the Mag 7, right? The Magnificent 7, not the NASDAQ 100, but it mirrors the NASDAQ 100, obviously. It also mirrors, if you put the NASDAQ 100 next to the Nikkei, it looks just like this. So it's kind of interesting. Yes, but I'm gonna slide this in. I did a video this morning, actually for clients. It's going to be posted, a snippet of it, for anyone who's interested on YouTube tomorrow, which is talking about kind of the Magnificent 7 breakout that we have seen since October 26th. So literally, I posted this for clients and said, we're either going to bounce hard or trounce hard right here. And obviously that's a directional move, but we got to see it. And that was the Friday before the gap down, right, leading into FOMC last week. And we had already talked about that we were expecting, as every Monday before it, to have the VIX crush, right? It's what, 18 Mondays in a row, whatever it is. We literally talked about it the Thursday before, in expectation that VIX would be, depressed, compressed, suppressed into FOMC. And then we'd have to see. And then we actually got the Fed statement, and then we got Powell's intonating pause and Yellen coming out with a QRA. And it was very different because it was more heavily skewed toward the short term and bills versus bonds, which are kind of kicking down the road there. So long story short, we had a massive bounce that was also fueled by short covering, et cetera, et cetera. So we've talked about all that stuff. Now here we are, right? And it's the same thing. Everyone's looking at the same technical chart on a weekly, 4 Qs. For the Magnificent 7, and we got to see what's going to happen rest of this week and beyond.
Watch the full episode and subscribe to LaDuc Trading YouTube channel for more macro to micro videos and other content.